Thanks for listening to episode 249 of This Week in Real Estate. The T-Wire podcast broadcast live Wednesday, October 4th, 2023. Housing emergency alert. Oh, let me read that. I don't know why my words just slurred. Housing emergency alert. This episode was brought to you by listeners and viewers who are just like you. I don't have a Patreon anyway for you to give me any money. I'm not even asking for it. All I'm asking for is that you just send the show to someone that you might think might benefit. That's usually somebody in the real estate industry or an investor, maybe a client you know. We're going to be diving into the real estate headlines. And if you're joining us live, you can add your voice to the conversation just by commenting. And I can display your comment and talk about you, just like Dusty did. What's up, Dusty Martin? She's here just to say that she beat Matt LaMarche. Thank you guys for coming and joining us on YouTube. You can also comment live and we can display those on Facebook and LinkedIn. And if you're joining us in Clubhouse, you can actually add your voice to the show. So you'll be in, Julie Moon says, LaMarche is busy helping one of her referral clients. So good job. Good job, guys. But if you come on to Clubhouse and raise your hand, the moderator is going to check, make sure you actually have a good profile there. And you can actually add your opinion straight to the show. It'll be broadcast live and on the podcast all at the same time. So the whole reason why we created this show is so that you guys can get a quick, succinct, professional analysis of exactly what's happening in the headlines all around the world. One place to go for about an hour-ish. And if we go over, we're going to hear the emergency alert. So hopefully we're not going to go over this week. But thanks everyone for joining us. And thank you guys for sharing the show and doing all the YouTube things while you're here too. So we're going to get right into it. There's a ton of news today. It's not as busy as last week, so we may have a little bit more time to sit on some of these topics. But first up, we're going to go straight into mortgage demand. This article is on, well, I'm displaying it, but now I can't find the window that I'm displaying it in. Hang on. All right, this article is on CNBC. Mortgage demand drops to the lowest level since 1996 as interest rates head towards 8%. Dun, dun, dun. You know, everyone that is sitting right now with a 6 or 7% interest rate is just hoping that a whole bunch of people buy at 8 so they feel better about it. Mortgage rates continue to climb higher, taking a particularly big leap this week. As a result, the total mortgage demand fell 6% compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. This quote is from Joel Kahn. He's the Mortgage Bankers Association Vice President and Deputy Chief Economist. And he said, as a result, mortgage rates continued to move higher last week. And as a result, mortgage applications ground to a halt, dropping to the lowest level since 1996. Applications to refinance a home dropped 7%, were 11% lower than the previous week. Applications to purchase a home fell 6%. So it doesn't seem like this is getting any easier anytime soon. Kahn went on to say that the purchase market slowed to the lowest level of activity since 1995 as the rapid rise of rates pushed an increasing number of potential home buyers out of the market. And that's kind of, as we've been looking around, a lot of people are super rate conscious. And, you know, if they thought 6% was high, if they thought 7% was high, as soon as we hit that 8% number, there's going to be a lot of people regretting that they didn't buy at the 6% mark. Just like people regretting that they didn't buy in the 5s now. Inventory still seems to be an issue, but with the severe drop in buyers right now due to the interest rate, my question is this going to provide some reprieve on the supply? Are we going to have a moment of ease where maybe we can see home prices not go up anymore? What do you think, Mike? Maybe you're there. Maybe you're available.
As far as interest rates, they're going to go up.
Well, are you seeing the increase in rates having a severe impact on the number of buyers that you're working with, or are they still willing to buy right now?
Not severe. It's like people are trained. They've been trained for the last year to be used to, 6.5 and up, and they don't remember if they've started looking in the last year. They don't know 3 or 3.5 or 4. So they're looking at it out of necessity. Like right now, I've got buyers that are living with their parents. They want to get married. They don't want to live at home anymore. So, it just depends on the motivation. And Another one is an extended family where, they can afford $1 million house and they want to get out from under the roof with everybody else. So it just depends on the needs and how big those needs are and what they're used to.
That's interesting. Pete Thorpe kind of echoes your sentiment too. Over on Facebook, he says it depends on the market. We're still seeing multiple offers in Maryland and Pennsylvania.
Yeah, it's only the pretty houses. The nobody wants a fixer right now. Unless,
that's true.
Unless it's at a fire sale rate.
Folks are very condition sensitive. I guess we could call it that. Elizabeth Nightingale's on YouTube. She says that misery loves company when it comes to mortgage rates. Yeah, I think so too. And what's up, Jen? She's joining us from Portland today. Thanks for coming in. Okay, well, she says hi from Oregon, but she is from Portland. All right, thanks, Mike. ADU, what's up, man? I saw you raise your hand. You got something to add to this part?
Yeah, you know what? So I'm actually of the opposite. So obviously, everybody knows the headlines. I mean, it doesn't take much to look at all of the headlines, and they're all pointed in, a terrible situation that is not going to improve anytime. I look at all of this stuff as actually nothing but opportunity. And I don't mean that like in a, like a altruistic, like pie in the sky, I just mean it in the fact that I'm 53 years old and this is the third unique real estate market that I've seen in my lifetime. And I mean it by saying that this is the third. And the reason why is because I haven't been practicing real estate I've been practicing real estate just under 2 decades. So I've been a licensed real estate professional for 18 years and a licensed mortgage loan originator for 13 years. So I've only seen in the almost 2 decades of my, experience, I've only seen 3 unique markets. However, all 3 of them have been, the key word is unique.
Yeah.
And every one has been a greater opportunity than the one before. So opportunity number 1 was right after the Great Recession. Opportunity number 2 was during COVID. And then opportunity number 3 is what we're in today, which I don't even know if it has a term, but I'm just going to call it a balanced market because I don't believe that either side controls the market right now. I think we're in a balanced state.
And so where do you see as the opportunity here?
Yeah, so the opportunity is, so I'm in Southern California. Looks like California. So right now, and again, this is, so I practice my market.
There you go.
I could only tell you what I see in my market. Yeah. But in my market, what I see is the opportunity is that no one is standing in line. Mike just said, obviously the pretty houses are the ones that are going to get multiple offers, but the majority of the houses, no one is standing in line. And so that's the opportunity. So it's very, very quickly, if you're working with buyers, and typically the people that come into this particular room are buyer's agents, and that's a good thing, right? I'm not saying that as a bad thing. I think that's a good thing because those are the hardworking agents in the industry, the buyer's agents. They're the ones that are actually the movers and the shakers, right? And that's because they're the ones that are like underpaid, underappreciated, but they're the backbone of the entire industry. So right now, for your clients, literally no one's standing in front of them. If your clients are in a position where they can actually say, you know what, I'm going to put in a full list price offer, which is just the first negotiation. I mean, that doesn't mean anything. So your offer is accepted, big deal, right? But the opportunity is that now you're going to do your standard contingencies, right? Loan, appraisal, and inspection. So obviously, when you get back when you do your inspection, then you're going to go into what's known as the real negotiation, meaning the second negotiation. See, that right now, this is the only time you're going to have that opportunity. And let me repeat that. This is the only time you're going to be able to have that opportunity to position including yourself, right, to be able to purchase homes without standing in.
So,
the minute
you're dropping out here and there, but so basically you're saying that because of the current level, because there's no one in line, right now the buyers have an opportunity to renegotiate at the time of inspection, or at least negotiate some at the time of inspection, because previously in the last couple of years, you remember people buying and waiving the right to inspect. That could be, I mean, I just see that as a changing market. Like I remember the pre-COVID market feeling very normal, feeling very regular. And I can remember when it started to lean towards the sellers, because for the first time in my career, I was getting more than one property with multiple offers. And I was like, whoa, this is wild. Like I have 2 properties right now and both of them have multiple offers. That's crazy. And I can remember that feeling as it started to shift. And what I thought was interesting is that it never, since that day, it never let up. It's never swung back to the buyer's market or towards, it wasn't even a buyer's market, just towards normalcy. So I think you're right. In some parts of the country, you're starting to see no lines in front of the buyer where they have a little more time and they can maybe find the right home. But in other parts of the country, I think it's going to be very specific to where you're from and where you live, because I think in other parts of the country, you're still seeing multiple offers. You're still seeing people go over ask. And so it's going to be very dependent on the specific market you're in, which is why you need to hire someone who knows that area. Because if you're trying to hire someone that covers the entire state or something like that, I think you're going to be off. But thanks for adding your input to that.
And you know what? There's one more part of that, Ray, and thank you very much, because I wholeheartedly agree with everything you just said. The other component about that is that, and I know no one's going to believe when I say the following thing, but so interest rates right now are higher, but they're not high. And I'll repeat that. Interest rates are higher, but they're not high. Just trend the
they're about at the
30-year
average
fixed
right
rate
now.
mortgage.
Yeah.
Yeah. So they're just above the average, which the average is in the 6s. So the average is in the 6s. Right now, interest rates are in the 7s. So yes, they're higher than the average, but they're not high, right?
I think the main gripe of people, though, who are looking at the rates is we can't look at one thing in solidarity, whether we're waiting on it to drop and go down, or whether we're waiting on it to, stabilize. So there's less volatility. There's a couple of components to the affordability that are pretty complex, but when you look at the amount of income and the income increases people have had over time versus the cost of stuff, the cost of stuff has outpaced the rise in income. And now you also have higher interest rates. And I think that's part of the big gripe, is that the affordability it's not just rates, it's the overall inflation and just the cost of stuff being more expensive. But I think that's going to push people to more interesting opportunities for you specifically, like ADUs. Accessory dwelling units
Absolutely.
are going to be. But let me keep going. There's another
what, Ray?
article.
Let me just land my plane right here with the why. Right now, it's a great opportunity. So in California, I don't know if you know this, Ray, because I forgot what market you're in. But Mike and I are in SoCal. So Mike, is going to be confident in what I say. And then Matt, I believe, is in Atlanta. I think I remember you're in Canada.
I'm in
correct,
Arkansas.
Ray?
No, Olivier is in Canada, but he's not here today.
Okay. So Arkansas, 2 guys from Cali, and Matt from Atlanta. So what I will say is that in California, and this is statewide, all SFRs are potentially up to 4 units. 4 units. So the real opportunity here is when you realize that the SFR is, for, average list is probably like 863, right? So when you realize that SFR is actually 3 additional units, and again, additional, potential, those are the keywords, because not everybody can, because they don't have the space. But see, then you realize quickly, based on rent row and cash flow, that the properties today are actually on sale. And then you start to realize that because of that rent row, because of that, cash flow, you're going to say, wow, there's no one standing in line. Yeah, the rates are a little higher, but no one's standing in line. I can get the property. I can improve it, right? Force appreciate the property by doing 3 additional. And now I'm actually getting a property for where I'm having little out of pocket, or if not, nothing out of pocket. And the reason why is because there's one big significant change that's going to happen in California as of January 1st. The governor just has to sign it, but it's already passed. The Assembly bill or the Senate bill has already passed. And Mike, if you're not aware of this, definitely this is going to put a lot of money in your pocket. So ADUs have never been investor friendly. And what I mean by that is that it was supposed to sunset at the end of 2023 or 2024, where, up to a certain amount of years, the owner didn't have to occupy the single family home. Well, now, as of January 1st, as soon as the governor signs, and he might have already signed it as I'm here in Las Vegas, but what's going to happen is now that's going to go away. So now that means that there's no more requirement for owner occupancy at all. That's not going to sunset. It's going to be eliminated. That is a huge opportunity in California. So here it is. The SFR, the JADU, as in the junior ADU, the detached ADU, and then the Senate Bill 9.
Oh, you broke up again.
Yeah, we lost him.
Uh-oh.
But Ray does look Canadian.
I do look a little bit Canadian, but it's all the maple syrup that's that I use on my beard products. That's what makes me look Canadian. Sorry about that, ADU. But we actually, you must have gotten a call or something because it's showing that you got a call in there. But we have talked about some of that stuff coming up and how California is changing the rules. It could lead to a ton of opportunity for Californians. I have no idea also why it was showing. So for those of you who are just on Clubhouse, I display the Clubhouse room on YouTube and the live stream so that people can see you guys who are talking. And it keeps giving me this thing. It's like, we want to keep listening, and it's a countdown. So I have to use an incognito window to do this. But for whatever reason, it was showing that I got kicked out of my own room. So that's funny. I wasn't, obviously, because I was still on the phone. So I'm not sure what happened there. But anyway, there could be some opportunities. He mentioned that stuff could be going on sale. And it looks like that things might be finally starting to drop price. That's something we haven't seen in a while. Housing market update. More home sellers drop their asking prices as mortgage rates hit a 2-decade high. So this report is from Redfin, who we are going to talk about towards the end of the show, that they left the NAR. We'll be talking about more of that. So roughly 1 in 15, 6.5% of U.S. homes for sale had a price drop during the last 4 weeks ending in September 24th. It's up from 5.8% a month earlier, which is a sharp monthly increase compared to the same period in years past. At the same time, the median home sales price is up 3%. So the median is still up. It could just be that there are more transactions at the higher end than at the lower end due to supply, which pushes up the median. What's it mean for home sellers? Pricing your home right is delicate science. Yes, we are seeing that right now, especially as we are looking at condition versus price. There's 4 things that sell a property: price, condition, location, and the professional presentation of your property to the marketplace. And a lot of agents won't admit that last part, but it does make a difference. So I always tell our clients, I show them exactly how we take care of that last part. Location, we're not going to change the location of the house in most cases. So we're going to leave the house where it is. So there's only 2 things you could change to sell a home: price and condition. And that's the big comparisons that our buyers are making. Is this home at the right price for the current condition that it's in? Or is the condition that this home is in, does that match the price? Or am I okay paying this price? And if not, you've got to change one of the 2. You've either got to update the condition or you've got to drop the price. And I think buyers right now are super price sensitive because of the high rates, because they're putting more money down. I think they're very price sensitive. So for home buyers, negotiating with sellers, that's going to become more and more important. Many sellers are open to making concessions like paying for repairs or helping fund the mortgage rate buy down. Additionally, new listings have posted an unseasonal uptick since the beginning of September, meaning buyers have hit a bit more to choose from. But I feel like buyers have only buyers only have a bit more to choose from because of the number of buyers that are pulling back due to the rates. But they say listings have posted an unseasonal uptick, an unusual uptick for the season.
Realtor.com has like an infographic that they're pushing around that October 1st through 7th are the prime ideal times for buyers to find a home, just because it's that mix between inventory, more selection, fewer buyers. And I guess that's the historic date that they're calling the prime time.
Yeah, that is interesting. I'm looking up this as you were talking about it. I see the article. I don't see the infographic. Looking, but yeah, they have an article that says during the 7-day period, shoppers can expect to save more than $15,000 when compared to the summer peak for the median home price of $445,000. Interesting. This was published September 13th. Ideally, this week offers buyers more options with lower peak prices as well as less competition from other buyers, slightly more. So it's like the Black Friday of home shopping, except there's not lines. Because that's why it's the Black Friday of home. Well, if more people advertise this and if it gets out there, it's going to change, obviously. You have more buyers in the market. Huh, that's interesting. Thanks for that tidbit. All right, let's keep going. Is dating or is buying a house more stressful? Drop it in the comments. Let me know. Is dating or buying a home more stressful? I'll get in the comments. Right. Matt says Arkansas, Saskatchewan. Yeah, that's me. Is dating or is buying a house more stressful? There was a recent survey conducted by Redfin, and Redfin says that 59% of recent home buyers say purchasing a house is more stressful than dating. Almost 60%. That's crazy. Here's the full stats. Baby boomers were most likely to say the opposite, with nearly half saying that dating is more stressful. Divorce and finding a new job were the only two listed life events that the majority of respondents said were more stressful than purchasing a home. It's so funny. Buying a car, 66% said a home was more stressful than buying a car. 61% say a home is more stressful than potty training a toddler. 59% say it's more stressful than dating. Getting into college, 58%. Planning a wedding, 51%. Finding a job, 44%. And getting a divorce, 43%. So people think getting a divorce is less stressful. Wait, hang on. Let me read this graphic one more time. Share of recent home buyers who said buying a home is more stressful. So 43% of people think buying a home is more stressful. Oh, I get it. Okay. But that still means that there's 67% that think divorce is more stressful. All right. Sorry, I was reading my stats backwards. I was like, wait a minute. Millennials and Gen Xers are most likely to think home buying is more stressful than dating. Baby boomers are more likely to think the opposite. White home buyers say that home buying is more stressful than getting into college. Black buyers say the opposite. So they have a full report there, so you can see the other stuff they compared. But I thought that was really funny on Redfin. 59% of recent home buyers say purchasing a home is more stressful than dating. All right, so what's happening in mortgage applications? This article is on, what website is this? CNBC. And I'm having a little bit of internet slowdown too. We've got some storms in the area, but hopefully it won't affect us. All right, mortgage applications are being rejected for insufficient funds, kind of. Insufficient income is what it says. More mortgage applications are being rejected for insufficient income. But this was not this year, this was last year. Nearly a quarter of refinance applications were rejected in 2022, up sharply from 14.2% in 2021. That's a pretty big increase. That's like a 10% increase. Last year, lenders denied loan applications due to insufficient income more often than any other point since records began in 2018. Overall, 9.1% of home purchase applications among all applicants were denied in 2022. Consumer Watchdog Agency reported a higher than 8.3% in 2021, but a marginal increase from 9.3% in 2020. Refinance applications were more frequently rejected at a rate of 24.7% in 2022. What I thought was interesting about this is if you think about it, like there's fewer people that are applying for a mortgage right now. So you have fewer people that are applying and more people that have been rejected. in 2020, 2021, tons of people were trying to apply for a loan or refinance. And so you had a much smaller percentage. Right now, it's almost like the people that have to buy are the ones that are looking to buy. So you have more serious buyers. You have fewer people that are just checking it out to seeing if they could refi. So it kind of makes sense that the rates would be, the rate of rejection would be higher now. But on the one hand, you would think, well, if there's a lower rate out there, it's going to attract more people to try. But it was likely, maybe it's the rate having something to do with checking debt to income payments. If people have a higher percentage interest rate, their monthly payment's going to be higher. So when they look at the income and what percentage of income that monthly payment takes up, that's going to be a larger percentage. So you're going to have more rejections. So I think all that makes sense, just kind of common sense, but the way it's presented in the headline makes it sound really scary. I don't think it is. Here's another scary headline. Climate change pushes up insurance premiums. If you're a fan of the show, you know that we've talked about this in the past. And the way we've talked about it in the past was the change in insurance that allowed them to look at the future potential risk versus the historic risk. For instance, flood. Previously, they would look at a 500-year floodplain, 1,000-year floodplain, 200-year floodplain, all that stuff. They say, well, I hadn't flooded here in 200 years. So the likelihood of it flooding again is going to be pretty low. Well, now they can futurecast. And they can say, well, it looks like there's a higher climate risk in this area due to future climate change. So we're going to increase insurance premiums over here and over there. And people said, nah, that's not going to happen. Well, here it is. Here's the article. Recent study from Policy Genius found that a quoted homeowners insurance premium increased 21% nationally from May 2022 to May 2023. Florida experienced the largest jump, with premiums increasing 35%. Also, maybe in Florida due to some lack of competition as more people are leaving the market. Natural disaster risk is the thing that they're saying drives up cost. Homebuyers prefer homes with lower climate risk. Yet we had the article from last week saying that more people were moving into areas of high climate risk. So that part of the article doesn't make sense. Affordability will soon worsen without government action. Teresa Benny says insurance is insane in California right now. I'm assuming you mean insanely high. Yeah. All the coastal areas, all the regions with multiple instances of potential natural disaster, insurance premiums, they're going to get to raise their premium for you guys because of the future potential risk, not necessarily what's happened in the past. Next up, this article is about assessors versus appraisers. It happens to mention Donald Trump, but I thought this was pretty interesting. I'm wondering where it's going to go from here and if there's going to be an additional lawsuit, because it doesn't. I think anyone who's a professional in the real estate arena kind of knows that this is not how it's done. So real estate insiders question how Trump fraud judge valued Mar-a-Lago. So if you're new to this, some say Mar-a-Lago should be estimated in the $426 million to $612 million range. The judge said it was worth 18 to 20 to 27.6 million. There it is right there. 18 to 27.6 million versus 426 to 612 million. He said that's a 230% or a 2,300% overvaluation compared to what? The assessor's appraisal. Matt Thomas says, make assessors great again. So anyone in the real estate world knows that you don't value a home based on the assessor's value. Appraisal values and market values are not the same thing, or assessor values and market values are not the same thing. Douglas Edelman, agent in Florida, said that in her experience in the ultra luxury marketplace, the tax assessor valuation isn't considered when trying to value a property. The agent from Douglas Edelman, her last name's Goldenteyer, Dina Goldenteyer. She says he wouldn't make a very good realtor. It's so widely known that it's not an accurate determination of market value. Talking about the judge. if there is a ranking as to what would have been the lowest valuation, it's the tax assessor's office, followed by Zillow. Then the realtor's valuation is the highest. So they have all these people chiming in. This article's on CNN, basically saying that to use the tax assessor is insane. Completely disconnected from the facts and governing law. So there you go. We're going to see what happens with that. I'm really interested because if they do use the assessor's valuation, then it sets a pretty dangerous precedent. And I think more people are going to go to their assessor and say, hey, I'm going to need you to make this more accurate. But assessor's like way off. I think on my home, it may be missing a whole digit. So that's not good. It's not good at all. What the assessor values our home. All right, so let's dive into some industry.
Ray,
yeah, go ahead.
Apologies, Ray. That's something that we're actually experiencing in Southern California.
Mm-hmm. See?
And the reason why is because, right, obviously, that's one of the big, questions is if I do improve, meaning if I convert my garage into a 1-1 or studio and bathroom, how's that going to affect my property taxes? So right now, the assessors, the county assessors like Orange County and LA County, they have not done a good job of actually communicating how it actually affects. So, in a nutshell, it's amazing how the landscape of ADUs is still in its infancy stage. And the reason why is because, there's not a clear formula. There's nowhere you can find, like, clearly, if you do this is exactly how much your assessed value will go up. So that doesn't exist.
Well, Pete Thorpe just chimed in on Facebook and said that they can only increase assessor values by a certain percentage anyway. So even if you had like a giant increase in value, the assessor's limited at what they could do every year to catch up to what that valuation is. So that would be that's going to be a problem anywhere you go in the US, I think.
I'd like to see that article. Oh, I'm sorry, Mike. I'd like to see that article, and then I'd like to ask an assessor if that's true based on what the article reads. And the reason why is because, no one's been able to actually tell me, and I've asked several times, like, how. And it's just a very generic answer, but the reality is it should be very straightforward.
Well, one of the interesting things about Mar-a-Lago is kind of what you're talking about. It is not a single-family residence. So Mar-a-Lago was used as a social club. It was classified as something kind of different. So that even it's kind of what you're talking about. It could be classified as something different. So, Mike, what were you saying?
Well, in California, we have Prop 13, which limits, how often or how much they can raise the tax base each year. But a major improvement, like adding an ADU or adding, a second story to your home, that could trigger a reassessment, and it wouldn't be confined by Prop 13.
So a reassessment outside of annual, it can be different.
Yeah, exactly. I don't know what the threshold is, but I have had friends that have added an ADU, and about 18 months later, the assessor knocks on their door and makes an adjustment. So,
hey guys, remember me? I think it's a really interesting case. We're going to see what happens with assessor values versus appraiser values. And if that Mar-a-Lago estate is valued at $18 million, it's going to be like a shot heard around the world because that's insane. Anyone can see by looking, it should be way more than 18 million. Maybe not 600 million, but it should be way more than 18. That's for sure. So we'll see how it happens. Maybe they should call SCAP, get him out there to appraise the thing. All right, so let's talk industry tea a little bit. Redfin's leaving the NAR, and I want your opinion about it. Real estate agents who are just joining us now, you all know that 2 weeks ago we had the NAR accountability guy on the show, and he's calling NAR to a higher standard of accountability. And not only because of the sexual harassment stuff that was up at the presidential level, but also because of the rampant spending that is not really being reined in, and they're spending like $46 million on a marketing consultant, and they don't really have anything to show for it. So it's just kind of crazy how much money they're taking from agents and then what they're doing with that money. There's a lot of questions about maybe the best use of it that, we've kind of had in the industry for years. So Redfin says that the sexual harassment stuff was the straw that broke the camel's back. So let me show you the report from Redfin. There it is here. So this was on the Redfin site. That's kind of hard to read. Let me see if I can change the view a little bit. Kind of. That's a little easier to read. Okay. So here's a report from Redfin. They said it's been a long time coming. They pay $13 million in dues every year. There's a pattern of sexual assault and harassment in the CEO level. They resigned from the board. Redfin will require many agents to resign from NAR, but they can't do everywhere because some MLSs require Redfin to be a part of that board in order for them to pull the data. That was my big question, is if they remove themselves from NAR, they're going to be kicked out of a lot of MLSs. How are they going to gain the data? They're still going to have to be in some MLSs because of their, the agents have to be there to list properties and they have to be connected to get the data feed. NAR has forced an all or nothing choice on us, so we choose nothing. In many markets, we can't even do that. He said, we want NAR to decouple MLS access from NAR support. I think that's the next big lawsuit. I think that's what's coming. NAR's decoupling from MLSs. I think that's going to happen for two reasons. One is the MLS PIN thing that we're going to talk about in a second, where because of NAR's rules, that MLS had a rule established that echoed what NAR did because they were, I guess you could say, bedfellows with NAR. And they had the commission requirement where if you listed a property, you had to have some kind of buyer's compensation because NAR had that rule out there. So they quickly removed that. They actually joined the lawsuit on the plaintiff side, I believe, to help out the plaintiff sue other companies that were involved in the lawsuit. And I think this is the future lawsuit is NAR's decoupling from MLSs. Redfin says that we're committed to our industry's future and NAR isn't the future. Whew. That's pretty bold. So some are saying, with maybe a more, what's the word I'm looking for? Sinister look on this. Some are saying that Redfin is doing this because they have such a huge database and such a big website that they're basically trying to pull everything from NAR because they view NAR/Realtors as a whole as competition. And they want people to go to their website. I don't think this would be the way to do it. I think if they were going to do that, I don't think they would choose this way to do that. There's a couple of other articles that mention this. One is BAM, Broke Agent Media. And I'll share this tab too. So Broke Agent kind of has a similar take as the NAR accountability guy. They've actually had the NAR accountability guy on there as well. So they wrote about it. They said it was a straw that broke the camel's back, talking about the, Redfin didn't already like the NAR. And then when the leadership had the sexual harassment and basically paid off the victims to be quiet using membership dues. That was kind of the straw that broke the camel's back, I guess you could say, from Redfin. And so they echo it. Another outlet that had it was Inman, of course. They kind of had the same thing. And then I like this photo. I like the photo on The Real Deal. So let me bring up that part too, so you can see, share this tab instead. So really interesting to see the folks that are kind of involved in these lawsuits and Redfin's stance on it all. Oh, you have to subscribe. So that's all I could show you. It's just the photo, just the above the fold photo. So NAR is they're in the thick of it right now. If NAR came out and said, hey, we're still committed to real estate agents and, we're committed to transparency and fixing all this stuff, blah, blah, blah. I can find the specific quote, but it was something along those lines, that they normally say. And if you look at the comments of agents, what agents are saying in there, it's basically, what have you done for us? We support Redfin in this, maybe we should leave too. And so I think it's going to be a question that real estate agents have been asking for years is what is this group NAR actually doing for us? Versus why are we paying all these dues? And then I think you're going to have leadership in companies start to evaluate the position. I think you're going to have leadership in companies that are bold start to evaluate their current position at NAR and start to ask some of those same questions. Like, what are we as companies asking NAR to do for our agents? You know, if Coldwell Banker and Keller and Century 21 Group, Berkshire Hathaway, if they all got together and said, okay, why don't we kind of rally the troops here and figure out what we actually need from a trade organization and see if NAR will do that for us with the dues we're already paying them. And if not, let's all just start our own trade organization. If they did that and they said, okay, here's what the trade organization is going to do. You know, we're going to create a national MLS for consumers that lists the agents on there. We're not going to require anything that they're going to go through with all the current DOJ's lawsuits and, you know, be right about that. And we're going to cut expenses like crazy. We're not going to market anything. You know, we're going to put all that stuff in the hands of agents. Like, there's no other, I was trying to think the other day, like there's no electricians org out there that is taking so many dues from electricians and then trying to be this massive org that advertises on behalf of electricians. Like, that's not how they operate. That's not normal. So I can't think of another organization other than NAR. Maybe you guys can help me in the comments. What's another trade organization that takes the same tactic as NAR as far as the strategy goes? What's up, Jack?
So Ray, wouldn't that kind of similar to would that be similar to like fraud? You know, people in the auto industry, the UAW.
So Elizabeth Nightingale just said unions. Yeah, I'm not a huge fan of the union. But yeah, I mean, that's two of you have just said that. IBEW, International Brotherhood of Electrical Workers. Okay, let's check out the International IBEW. How much, what is the IEBW dues? $200 per initiation and $12 monthly. No, that can't be it. We'll find out. There it is. International Brotherhood of Electrical Workers. Like, there's no like electrical worker ad that you see. There's no like they don't spend $46 million on marketing for IEBW or IBEW. So it's still even I know there's tons of trade organizations out there, but I can't think of one that operates similarly to how NAR operates. That's what I'm looking for. So drop it in the comment. Elizabeth said yes. So they do have ads for IBEW. I can't imagine what that is going to look like. I'm on their website now.
So Ray, actually these trade unions actually do advertise, but they advertise actually when it's, and I don't want to use the word convenient, but yeah, I mean, when they do need to advertise on behalf of their rank and file, their membership, they will advertise. I mean, there's huge unions for trucking industry, you know, the Teamsters, longshoremen, the oil, atomic and steel industry.
So the only related trade organizations that we can find are actually unions, is what you're saying.
Yes, it you know, again, it's an opinion, right? It's my opinion.
No, yeah,
but
that's what
the closest thing to NAR, yeah, is definitely trade unions. And the reason why is because the number one thing I hear of the purpose of the NAR is, you know, not so much what is advertised, but the number one thing of why, you know, we have someone like an NAR is because of the fact that they are a huge lobbyist.
Yeah.
So NAR's primary role is actually to protect our commission. That's their primary role. Now, you're not going to hear anybody advertise that, but that's their primary role. So now, do other unions protect? Meaning, do they lobby? They don't lobby, but they do. Obviously, unions do protect.
Well, I think they lobby. No, yeah, I think you're right.
So I think that the closest thing to NAR is a trade union.
I think a union does lobby. They lobby for wages. Right now, they're doing the whole strike thing, the auto workers. So I would say they're lobbying for, right now they're lobbying for a lot of support from the Capitol for their strike. So yeah, you guys may be right on. Matt Thomas says he hears commercials for ironworkers unions. So unions offer benefits sometimes. Elizabeth said, unions offer benefits sometimes. Where are my benefits? Asking for a friend. Well, Elizabeth, I don't know if you know this, but there's a NAR travel club. So if you're not taking advantage of the NAR travel club, in which you can buy stuff for like $2 off. I traveled quite a bit this year, and I looked through the NAR travel club to try to buy stuff through that because, you know, I'd like to support it and maybe get some discounts and stuff like that. There's nothing. It was terrible. I couldn't use it at all. Elizabeth says she has AAA, so she's good. Okay, good. I think you guys are right. I think and this is kind of the point, I guess. The only thing that you could think of that's comparable is a union, but it's not a union. It's a trade organization. But they are taking the money and operating similar to a union. And that's strange to me. I don't think that was the original intent of the group. And one of the things that you mentioned was the protectionism for commissions. And so I'll bring up this article too, because this happened just this week. There's two things that happened. Number one, the DOJ put DOJ intervention put MLS commission settlement on ice. So they delayed the MLS commission settlement. And when they did, the plaintiffs in this one, and I can't remember if NAR is part of this one or not, but the plaintiff said, what? You can't delay, blah, blah, blah. And then they basically said, okay, fine. Here's what we agree for the delay. And so they did delay it. As they did, the follow-up article on that is also on Inman. And it says that the MLS commission settlement in jeopardy amid the DOJ's quote unquote concerns. So this is the one with the MLS pin that I was telling you guys about. On Friday, attorneys for the DOJ Antitrust Division asked Judge Patty Saris of the U.S. District Court in Massachusetts to extend by 2 months the upcoming deadlines for reviewing the agreement between the plaintiffs and the broker owned multiple listing service MLS Property Information Network. As part of the deal, MLS PIN agreed to overhaul its commission policies and pay $3 million to cooperate in litigation against the remaining defendants, who are Anywhere, Remax, Keller Williams, and Home Services of America. So NAR is not named in this one. The United States has significant concerns with the planned rule changes under the proposed settlement. The DOJ September 28th filing reads. Now, the proposed settlement, the DOJ already agreed to, and the changes were put in place, and the DOJ said, yeah, that's great. And now since then, the DOJ is going back and saying, wait. So NAR, well, the brokers involved in this one are saying, well, you got to stick to what you said you would do. And NAR is saying this in a different lawsuit as well. So if the trade organization is supposed to help real estate agents protect how we get paid, it seems as though due to all these class action lawsuits and what's happening is that they've done a terrible job of that so far. So we'll see what happens, but there's been two, Remax and Anywhere have both settled. So there's been two big brokerages named in some of these lawsuits already that have settled, not for this MLS Pins one, but for the others, they've settled. And so if they settle so quickly because they don't feel like they have a case, then NAR over the past how many years has not done their due diligence in making sure MLSs, or not MLSs, but agents around the country were protected and that it was working. You know, we had a system in place and that it was working. So there's major issues with it, major issues with the legal department, who is only getting about $6 million. Maybe they should have given the legal department $46 million and given the marketing department $6 million. Maybe that change would have helped. But Elizabeth Nightingale said NAR for president. No. I can tell you this, though. If I get Bob Goldberg's job, I promise to lower the amount that the CEO of NAR gets paid once I leave. It's like $2.5 million a year. So I got to take that for a couple of years, but then I promise after I leave, I promise to have that lowered way on down there. But there's a huge question. What is Bob doing? I asked somebody that's in the know, and he's like, oh, there's a whole lot that he does. I'm like, okay, well, let's get a list. Let's take a look at it, and let's see if we can maybe outsource some of that stuff. There's someone else that could do some of that cheaper than $2.5 million. Because so far, with all the lawsuits and everything that's happening, all we've got is an NAR travel club and the NAR RPR. Now, if you haven't used NAR RPR, that's the best thing to come out of NAR since I've joined NAR 17 years ago. So NAR RPR, by far the number one best tool, best thing that they've ever done. Everything else is just, I don't know. I'm a little upset with them.
You know what, Ray? I think that something that I don't think it's going to happen yet, but it's definitely, being threatened is the what is it, 500 or 600 MLSs around the country. I mean, it's hyper fragmented. I know that Zillow, their grand vision is literally to be, well, they are in a way a national MLS already, and Redfin is closed. So the national MLS kind of already exists, with Zillow kind of in first position and Redfin maybe.
Kind of, but it's in no control of real estate agents. But yeah, kind of.
Right. So I think that that's kind of like the next disruption is, and I don't mean, because I mean Zillow and Redfin have already done it, so that's not going to be disrupted. I think that the next thing that's going to be kind of disrupted is right now people are questioning, okay, what is the NAR doing for me? And then real estate agents, because we see this in SoCal, real estate agents are also saying, okay, so for my local board, right, and I'm with Pacific West Association of Realtors, what are you actually doing for me as well? I mean, because so currently right now, and that is also a pending lawsuit. So one guy from the agency that works with Mauricio Umansky, he's the one that started the national listing service, the NLS.
Yes. Yeah, we've covered them, the pocket listing service, basically.
Yeah, exactly. So it started as the PLS, the pocket listing service, and then they got sued, and then now they've changed it or rebranded to a national listing service, the NLS. But that's an ongoing lawsuit that I don't think has been. I don't think that's been finalized. But
here's part of the problem of the PLS NLS, and we talked about this as it's been going through the years. It's a story that we keep coming back to. But basically, the PLS launched, and then they said, "Hey, no pocket listings," and so they were like, "Okay." So there was an article in February of 2022 that said that they were changing it from the PLS to the National Listing Service. But I don't know where that lawsuit is now, but it's been there for a long time. This was back in Rex. Y'all remember Rex? They were suing. I think they sued Zillow and wound up settling, or maybe there was a change, but Rex and the PLS were kind of all at the same time coming out. And now it's the NLS. I would love for there to be a competitor in the market space, but it's going to take all the big guys. It's going to take all the big guys to say, okay, guys, let's get everything together. We're going to own this as agents, and let's create a national MLS, an alternative for everyone to join. You don't have to join your board MLS. Let's just all join this one. And I think go ahead. Sorry.
No, apologies. I think I interrupted you first, so I apologize for that. On a unique type of property, so again, it's unique types. It's not for everyone, but on a unique level, I'm getting ready for someone to file a formal complaint against me when I do launch it, because it's inevitable. It's going to happen. But I've already gotten the trademarks and the .coms and all of the things that I need to do on the back end. I'm going to be launching the ADU MLS.
Yeah, that makes sense. That's great. Right? I think that's a great idea.
The idea is great, and obviously the execution will happen, but I'm confident that someone will be launching a formal complaint. I don't know who that someone is yet, I've got my theories, but obviously I'm prepared, and so are my investors, that it is what it is. But it literally is, the timing is perfect to have a national MLS. However, we are exclusive to the property type, which is accessory dwelling units.
Well, I think as soon as we do have a national MLS, I mean, if NAR were to say today, okay, guys, screw everything else. We're not going to do this marketing spend, $46 million. We're not going to do the who we are videos anymore, as Pete Thorpe said, but we have a brand new spanking R. We're not going to try to reinvent the Realtor R and make that says. What we're going to do is put a tool in the hands of consumers that connects them with real estate agents. And we're going to call it the, Realtor MLS or whatever, RMLS. This is actually that sounds really good, actually, Realtor MLS. And the Realtor MLS is something you could put in your own data feed. You don't have to join local boards. You don't have to do, and this is the reason why they won't do that, is because they're making so much money off the local boards and such, but you don't have to join your local MLS. It's just national MLS. It covers everyone. Everyone puts in the same data. That data feed is then kept with us, and people would have to subscribe to it, and the money would go back to the agents who are inputting the data. Right? If that happened, then NAR suddenly has my full support, and I think the full support of a ton of people. And the Houston Board of Realtors has done a great job with their MLS, and because of that, the Zillow can't really get a foothold in Houston because so many people are using the Houston area's MLS because they made it consumer facing. And so I think that would be Pete Thorpe said, like, I don't know, something like realtor.com. Yeah, that ship has sailed. All right, let's keep it moving. We got speaking of strange bedfellows, EXP and Opendoor have a deal. What? This article is from Broke Agent Media. Opendoor and EXP have partnered to give homeowners an incentive to sell by providing certainty in the sale via Opendoor's cash offer solution. Opendoor will be primary cash offer solution powering EXP's iBuyer platform. Express offers and EXP realtors will be able to participate. So Opendoor also has a partnership with Zillow right now. So Opendoor is kind of like the cranberry sales guy, right? You like cranberries? I make apples. How about cran apple? You like bananas? I got cranberries. How about cranberry? That's an old joke from Brian Regan. It's phenomenal. I feel like Opendoor is kind of like that, finding ways to partner to get these cash offers out there. Opendoor has shown 1 quarter, I think, of profitability. Zillow stopped their iBuying program because it was not profitable. It looks like EXP has not been as profitable, so maybe they're looking for a partner in that. You would have to think that if EXP had a really profitable iBuyer program, why would they partner with someone else to do it? So you'd have to assume that maybe that side of the business isn't as profitable as they once hoped, so they're bringing in someone else to take over that. Basically, Opendoor is taking over their cash offers program, or will be servicing the cash offers program.
Ray, I think that's brilliant.
It says, does this mean Express Offers will only present Opendoor offers? Again, based on the wording in their original Opendoor announcement, Opendoor will become the quote primary cash offer solution. But I think when Opendoor, as it became popular in different marketplaces, real estate agents were submitting their clients' information through the Opendoor platform and then taking that to the listing appointment saying, hey, if you wanted an offer from Opendoor, this is what it would be. Or you could sell it on the market. Here's how much you could sell it for. I think agents that have been in the business a long time know that the cash offer, fast cash offer is something to get people to call you and say, well, I would sell. It's very rarely the one people choose because it's so far below market and there's so many other fees. Another listener to the program said that there was about 8 to 10% of additional fees with the Opendoor offers in their marketplace. So there's additional fees and it's a lower offer to start. And oftentimes it gets renegotiated after inspection. Due to those issues, it's really just a lead gen thing. So I think there's probably a lot of agents that could find an investor that would give below market cash offers and say, if I can make you my cash offer guy, I'm going to go generate a bunch of leads for us. And you just tell me what the cash offers would be on these. And then the rest of them that don't take that cash offer, I'll just sell normally list on the market. And there you go. You've got your own little iBuyer program.
I was just going to comment that I think it's brilliant that they're still in business, as in Opendoor. The reason why it's brilliant that they're still in business, and I think they're going to survive, is because the market currently right now, the environment doesn't complement their business model, right? Which is why, like Ray said, Zillow and EXP had to kind of shutter, their doors and started to partner with Opendoor. But the reason why I think that it's brilliant that they're staying is in business is because I believe that the market will shift where then it will benefit their business model. So, how much time?
But when the market was right, when homes were increasing 10% over a 2 to 3 month period at times in some markets, they were losing money. So I don't see how they fix that to then be profitable, to be honest. I think there's major issues. I think they have major issues that go beyond market. I don't know how they can turn, if they can't make money from 2020 to 2023. I don't know how they can make money going forward in a market that favors buyers. When buyers can take a long time to choose. I mean, maybe that's the trick, is that they're going to, all these homes that have been lingering on the market a long time that didn't sell for what people thought they were going to sell. Maybe that's how they do it. And then they just buy and hold for a while. And then they change, they change the strategy down the road when the market does uptick and they start to sell them off. But I mean, their strategy is to buy and flip, not to buy and hold. So I think they have major issues in the how to make money situation.
That's actually where I was headed, is that they had to transition their business model, right? Like you're right, Ray. They're a buyer and holder, but the market says that's not going to work right now.
Yeah.
So I think that I'm sorry. They're a buyer. They're a buyer flipper.
They're a buyer flipper, right?
Phase one. But now phase two, because they're still here, is now they're like, okay, then I guess we're a buyer and holder. And the reason was because the economics support that phase two model, meaning prices are not coming down because of the low inventory, supply and demand. Prices are just going to continue to go up.
Yeah.
So meaning their phase two business model says, hey, just stay, literally just stay in put, just stay in place, and the market will come to you.
I think they're going to have to make some kind of change.
Brilliant.
I don't know what the change is going to be. I haven't seen it yet. They're going to have to make some kind of change in order to make money at it. Teresa Benny on Facebook says Opendoor has lost a lot of money on many listings here. I don't understand how they're still in business. I've seen listings sit to the point where they have squatters in the property and the listing agent didn't even know. That's a report that we hear over and over and over. But I've said this on the show too. Anytime you have a market player that enters a market and their number one goal is not to make money, then the people that are also in that space that are trying to make money are at the disadvantage. So Opendoor was never a competitor for real estate agents. It was a competitor for investors. And if you have an investor in a marketplace that doesn't have to make money, it changes the market dynamics in such a way where that investor, of course, is going to survive. They're going to be out there, Teresa, because they don't really care about the money in the marketplace. They care about the VC funds that are coming in and the round of funding that they can get. And, they care about views on a product. That's not something that a regular real estate agent nor a regular investor would be willing to compete with. So it's, they're going to have to make money eventually. How they do that is still up for grabs.
Hey, Ray, that's the first time I've ever heard anybody intelligently. I'm sorry, Jack. That's the first time I've ever heard anybody intelligently say what Opendoor's business model is really about.
Thank you.
It does not come seriously, Ray. I mean, seriously, they are not a competitor to real estate professionals. Look at them as a partner. So yeah, I wholeheartedly just support what Ray just said. Apologies, Jack. The floor is yours.
What's up, Jack? Jack Atteridge,
hey,
everybody.
Ray, how are you, man?
I'm good, man. How are you?
Ladies and gentlemen. Talking about another disruptor's, in quotations, business plan just hurts my head. I mean, nobody's come up with a great idea. the millions and billions that these guys dump into platforms. I mean, you just hit it. That they're trying to make some fancy slides for VCs, but other than Zillow, tell me a disruptor that has figured out something different than what we do every day. And what we do every day is, Zillow is great up until, and we've talked about this before, up until the last mile. The last mile is when the rubber hits the road, when people buy and sell properties, when we hold hands of the little old lady or the first-time home buyer. I mean, you see, I'm stuttering. you see corporate real estate models really struggle when times get tough, but then I see the homegrown guys who started out businesses and became regionally successful. They're out there striking, and they're buying up these people that are just paralyzed when a corporate boardroom isn't satisfied with returns. So I love Inman. I backed away from Inman a few years ago because every year it was like the disruptor convention, and the next year it was the next guy. And so,
the next year it was the next guy, and the previous guy never disrupted. That was
and spent a shitload of money.
Yeah. What are they actually disrupting? The pocketbooks of VCs. That's what they're disrupting.
Yep. Exactly.
Yeah. So speaking of companies and rivalries,
that's the second most brilliant thing I heard in this call.
There you go, Jack.
Jack hit the nail on the head. Is literally fancy slides for VCs, because that's exactly what they're disrupting. Fancy slides for VCs.
Yeah.
Because in an appreciating market, you're always going to get, here's the truth. You're always going to get money from VCs in an appreciating market. So any one of us can actually be a disruptor by putting together, like Jack said, some fancy slides and getting those fancy slides to the right people.
Yeah.
The right hand to then pitch to the VCs.
And then you're the innovator of the year.
Values are not going down. Yeah, exactly. Values are not going down. Values are going up. So if you're really struggling, if you're a struggling real estate professional, just like Jack said, just put some fancy slides together and pitch it to a VC, and you'll get tons of money.
There you go. All you need is a pitch deck. Now I have to come full circle. Real, the company that I worked for, was the CEO, Tamir Poleg, was named Innovator of the Year. We have a couple of awards this year from Inman, so I do appreciate that, because I think, I think it has legs. It's something where 12,000 agents are already at. So I think it's very different from what they used to do. So maybe they're changing their tactic just a little bit, but I agree with you, Jack.
I've got to jump in. My company here in New England, it was the broker of the year.
See, there you go.
So pretty proud of that. And he's a guy that started above a pharmacy 50 years ago and still runs a family business.
Oh, that's cool. So there's still some good among the Inmanites. All right, well, let's talk about this next deal, because we only have 3 minutes until there's a huge warning that happens, and it's going to take over everything that we have. Homes.com hits 100 million monthly visitors on Zillow. Homes.com hits 100 million monthly visitors. So Zillow's Rivalry is starting to heat up. Part of me wonders if that 100 million visitors were all the people that are currently using Homesnap that were redirected to Homes.com, because Homesnap is ending October 9th, and people are trying to figure out, well, what do I use for a home showing service now? So it remains to be seen. Let's see if they keep that after the Homes.com or Homesnap dies. But that was my biggest, as soon as I saw that, I was like, well, yeah, I went to Homes.com several times by accident because the pop-up that came up on Homesnap. There's another thing. See, Pete Thorpe said the same thing, because they took over Homesnap, and I hate Homes.com. Homesnap was much better. Yeah. Homesnap was way better than where the Homes.com is. There's several problems with the product right now, and it will not serve our needs. So we're actively searching for someone. Oh, there it is. See? Wow. All right, hang on. Okay. It's going off on everywhere. Everything just went off like crazy. Woo. All right. Sorry, guys. I know all of your stuff is going off too. That was a nationwide test. It was actually early. It says 1:18 my time. It was supposed to go off at 1:20 my time. So that was early. Sorry, guys.
So Ray, What is that?
That is did it not go off in your area yet?
Yeah, but I didn't read it. I just dismissed it.
It's just an emergency broadcast to see if they can push out an emergency alert on every possible device. And they did
for the next lockdown.
Yeah, for the next for the next pandy. All right, the last thing we're talking about today, CoStar lawsuit accuses Homesnap founder of stealing trade secrets. So the founder of Homesnap took a couple of other Homesnap folks with him and started another business. It's called Happening Technology. And basically the CoStar is suing because they stole their sync data transfer system and fast track to fast track a similar platform. So we'll see if anything comes to that. We'll kind of keep our ear to the ground. But that's out there. And we'll see also if Happening Technology actually maybe takes a space. I don't know why they're so concerned suing somebody that came up with the still trade secrets about Homesnap if they're about to sunset Homesnap. I mean, why not? If you don't want that product, let somebody else have it. Because I would definitely use someone else who's going to restart the Homesnap thing. They should have just sold it off. Anyway, that's beside the point. Well, thanks guys for coming this week. I really appreciate you guys for joining us. I am Ray Ellen. You can find me at Razorback. That's RAYZORBACK. Everywhere Razorbacks are sold. Instagram is really the best place to hit me up. Send me a DM. Let me know that you listened to the show. And if you made it all the way to the emergency alert, maybe I'll have something for you there. So shoot me a DM on Instagram and do all the subscribey and YouTube things. So subscribe, hit the bell, go to the podcast on Apple. Subscribe there and be sure you share it with someone. That's the only podcast algorithm that works, is when you have a lot of people that suddenly start to listen to something. Apple takes note and goes, we should probably push this out to other people. So I really appreciate you guys. Most of our listeners are audio through the podcast. So hello, and thanks for listening this far. So I'll see you guys next week. We'll be on next week in the 20th, the week of the 21st through the 25th. We won't have a show, just so you know. But I'll see you guys next week. Bye.